Let's get started. Interpreting exploration news releases, real-life examples. This is what Joe Mazumdar and I spend 90% of our time on at Exploration Insights. It's Joe's letter. I just sort of add what I can and throw him ideas, and he goes through them. It's really this is a really complex industry, as you all know, and it comes down to science. And you're looking for things that you can't normally see from the surface. So there's a lot of guessing in the game, and educated guessing or not. So what I want to do is just talk about some ways you can look at the data that's being presented and get a feel for if it's positive, negative, etc. Turning money into rocks, then and now. This is a sample of the best performing stocks in 2008 to 2011 run. And what you can see is the first one appreciated 1,200%. It's now delisted. The other one, Marisol, got up to $6. It's now 47 cents. Gold Canyon got up to about 370. It was acquired for 35 cents. Gold Quest, 4 cents to 265. It's at 3 cents. We got a win, Sandfire, 11 cents to 728. Anyway, you get the idea here that initial results can be extremely exciting and excite the market, but you need to follow it because we know that 1 in 1,000 or so stocks or prospects eventually turn into an economic deposit. And if you can figure out what that fatal flaw is ahead of the crowd, you can still make good money. So that's kind of my point with this slide. And I'm not just down, I don't mean to sound down on the exploration industry. It happens throughout. Here's some examples of a study that was done by Stevens and Burley about a decade or a couple of decades ago, but still the same thing. Out of 3,000 new raw ideas, 300 were actually submitted. 125 went into small projects. 9 looked like they were doing good. 4 ended up actually getting a lot of work done. 1.7 launches and 1 success. So it's not just us. It's anything that is very speculative and difficult and scientific. For pharmaceutical companies, it's like 1 in 1,000. So we're a lot safer bet here than there. Okay, so where do exploration companies and mining companies fail? You've all seen this Lassonde curve on the, whatever side that is, on your right side. But a study done by Burgess Mining Consultants comes up with 5% of prospects reach advanced exploration stage. And that would be, drilling. 0.5% reach the preliminary economic assessment. 0.3, feasibility. 0.2, achieve full feasibility. And this is the bottom chart is one by Doug Silver, of course. And the net result is he shows here out of 250 companies he watched, this is when they reached their peak price. And you can see that almost all of them reached the peak in the first year that work was being done. And then towards about 5 years, it increases again. So again, the point here is you need to follow these stocks extremely well and know what's going wrong. And I just attended Rick Rule's presentation talking about the stocks that he owns at this show. He listed more than 22 stocks, and I saw half the audience writing down these symbols. That's not going to work. Unless you know exactly why you own a stock, you're going to end up most likely losing money. You need to follow these stocks and know what's going on. Okay, why do they fail? Probably one of the biggest reasons is that the geologists don't really know what they're looking for. And by saying that, and I fell into that category years and years ago when I first got started, you get excited looking for a porphyry copper, and my gosh, we've got a little bit of copper veining here, but you need to back calculate. What every company should do is back calculate from what you need to make an economic deposit, what is it going to cost to drill it out, what is it going to cost to build it, and then come back to what you need to see in the initial stages of exploration to tell you that, yes, you're on track. You're coming up with a deposit that's going to have the grade and tonnage, the metallurgy, et cetera, to fulfill what you need to get. Size and grade, of course. Brokers, bankers, and influencers. There's a lot of new influencers in this industry who know absolutely nothing about mining. But they're incentivized to push bad ideas. And the brokerage firms as well, that one down below shows the distribution of ratings for, I think it's PI. But anyway, you can see that there's no sells. Makes you wonder. And the boom and bust cycle. I get the sense that, particularly for the precious metals, we are going to do all right over the next few years. All right, let's look at a really good open pit gold deposit. Rupert Gold. First hole showed grade and continuity. 137 meters at 1.8 grams. Another hole, 54 at 1.5 grams. Look at on the right, see how what the continuity is in those grades. They're just consistent. That's what you need to see in a bulk mineable open pit deposit. Really key. And you can see what the share price has done. And it's still a good deposit. It's a great deposit. Discovery to resource in 3 years. It was blind. Base of till sampling. They've proven up 4.1 million ounces at 2.2 grams, more or less. Strip's okay. Recovery's excellent. Finland, fantastic jurisdiction. Agnico, B2, and Kinross are in the area. And that's a tier 1 deposit. And you can see what the open pit's going to look like. And I've got there outlined in red, pro tip, if you will. Part of their deposit runs onto, or at least the open pit layback, and probably mineralization runs onto a smaller company called Orion Resources. Before this deposit gets purchased by a larger company, I think Orion and Rupert have got to make some sort of deal. So there's a play there before the thing gets bought out. And again, tier 1 deposits, that's what every company, the major companies are looking for in a safe jurisdiction. They're few and far between. Snowline, another one. Tough location, but this is the grade model for the open pit. Fantastic. The high grade sits right where you're going to get to it first time you start mining. That's what you're really looking for. And again, the continuity is fantastic. 135 meters of 1.1 grams, 283 at 2.3. There's better in there. That's what you want to see in a discovery, going to production. And there we go. Not hard to see that that is legitimate. All right, A-Mark. I just threw this in this morning. I'm not going to talk a lot about it, but look at the continuity of the copper equivalent grades. Again, really, really good numbers. They're consistent, and that's what you want to see, consistency. Let's talk about what you don't want to see. They've got a all-in resource of about 28 million ounces gold equivalent. Location. There you can see where they're located. You can see where the drill rigs are on the side of this very steep hill in a tough location. The drilling into the mountain. It's partially under a glacier, and the grade is actually pretty dang low. And they're looking at this as, for the most part, an underground deposit. At one point, call it 2 grams. Not so good. And the chart tells you the same damn thing. When you throw recovery in on this, they're going to get 63. Actually, the recovered grade is 0.63 grams per ton, and this is being looked at as an underground deposit in a very tough location. Your capex to build something like that is in a couple of billion at least. So that's another way. Look, and you could have made a lot of money if you recognized that early on. Another example of what you don't want to see. Very high grades. Continuity, clearly not obvious. Those purple lines are the very high grade kicks. To my eye, I have a hard time correlating those in any way. And I think what you need to watch out for, I'm not saying this happened here, but smearing grades, where you take a very high-grade sample and mathematically smear it a much bigger distance so it looks like you've got continuity when in fact you don't. Another thing people like to do is put the picture of their core or whatever with gold dots in it, with gold nuggets. Although that looks great, that is a real concern of mine, because when you do that, when you get it like that, it's very hard to make a resource estimate over any distance. Consider you're drilling a core about yay big, you cut it in half, you send half of that in to be assayed, say it's a half-meter interval, you've got one nugget in there, and you've got that down to a 30-gram sample you're doing the assays on. How are you going to project that over the next 20, 50 meters to make a resource estimate? It's very difficult when it's a very nuggety, inconsistent deposit. Likewise, when it comes to mining those things, they're very difficult to mine. So when you see those little nuggets, you want to look hard. And when you see those high-grade kicks, it raises a red flag. Not always killer, but it's a big red flag. I hope this is making some sense. All right, let's look at a good high-grade underground deposit. Southern Cross gold. It's Victoria, Australia. Really interesting discovery in an area that has produced a fantastic deposit nearby, same style of mineralization. Initial discovery, more or less, was 331 millimeters at 6.8 grams, 0.2% antimony, and this occurred in 7 zones with 18 high-grade veins. And on the left, you can see the high-grade hits, and there is consistency there. It continues to happen. It continues to happen. And you can map these things in that yellow vein. You can see that it's coming down, and the grade is there, and it's consistent. And when you go underground to mine it, you're going to know what you're mining. You're not going to be guessing. There's something called the coefficient of variation, which is basically the standard deviation over the mean grade of your sample density, your samples. And what that really means is what we're trying to determine is how consistent is the mineralization. And you don't need to know all these numbers and figure it out yourself, because this is what they put in a resource report or technical report. So just go to your PDF, Command F, CV, look for the coefficient of variation, and it'll show you, it'll turn it up. And basically what that means, what that tells you is, again, the continuity of the grade. If you've got a CV of 0.5 to 1.5, that's pretty good. I'm happy with that. 1.5 to 2.5, okay, that's probably going to work. You start getting over 2.5, your continuity's bad. And over 4, it's very poor. And you can see from the Southern Cross deposit what their ore looks like. And there are red flags there, definitely, but we checked the CV and it's working. It's not bad at all. And you can see where on the Apollo vein itself, where the continuity lies. And it's good continuity. And there's the share price. Someone's going to buy this too, I think. Again, it's a tier 1 deposit. They're few and far between. If you find one of those, buy it and wait, I think. Okay, so this kind of goes, I'm going over this again, but look, there's what the CV tells you. We looked at Pretinum, Brucejack deposit. It's a good deposit, it's not economic, but the first mineral resource estimate put the grade at 17. The mining grade is about 8 grams per ton, and their CV was out of this world. Their drill hole spacing to bring it into reserves and mine it is 7 to 10 meters. It's this. That's a lot of drilling, a lot of cost to do that. And if you're drilling out to prove a resource, you need that, or reserve, you need that sort of drill spacing, which is going to cost a lot of money, especially if you're trying to drill it from surface. Rubicon, the Phoenix deposit, complete bust, CV At 6 or 14 if uncapped, meaning they did not lower the higher grades, a bust. Klondike's at Fire Creek. CV7, grade dropped from 10 to 20. It's on care and maintenance. B2 at Back River. We don't know yet, but that's a rather high CV. Let's see what happens there. Pure Gold at Madsen, CV of 5. Busted. It's been reacquired. Ascot, Premier Mine, CV 3.9, suspended operations. So my point is, this is what you need to look for if you're looking for a deposit in a company that a major is going to buy, because they're going to look at these too. Closing thoughts. It's imperative that geologists and management understand what success looks like. And that's what I talked about right from the beginning here. Figure out what the economics are you need for a deposit, what the deposit looks like, and then back calculate what you need to be seeing in the results as they come through. And more often than not, you'll find the fatal flaw, and with a bit of luck, you'll get out before the crowd. Find that fatal flaw. That's what we do. Most stocks peak early. Again, it's excitement, nice drill hole or whatever, and then reality sets in. Metallurgy sucks. The government kicks it over. Any number of things go wrong. But if you really are onto a tier 1 deposit, add to it. They work. Add yours here, and I got my little science thing there, a pet peeve of mine. All these experts on the internet that know nothing about what they're talking about, but they attract attention. So that's what I've got to say. Joe Mazumdo, the guy on the top there, he runs Exploration Insights. He's got more experience than most anyone that I've come across. The letter itself is about what he's buying and selling with his money, plus it covers the market. We're compensated by subscribers only. And I think that's the model to go. It's about what he's buying with his money. That's it. Thank you very much. If there's any questions, I got a couple of minutes. Yes, sir. Do I think they'll figure out the Madsen mine? There hasn't been a lot of luck so far. It's a tough deposit. We'll see. The honest answer is I don't know. I'm not looking at it in that much detail. I know it's a whole new bunch of people in there and they got new ideas, so maybe. Yes, sir. Examples of where CV was high and the mine still worked. Well, yeah, Bruce Jack. But that was it dropped from what did I say, 17 to 8 grams? But 8 grams still works. Yes, sir. Okay, yeah, the Jarrett Canyon flow chart. I just wanted to show how complex these things are. And Jarrett Canyon has been has gone bust at least 3 times. And it's because continuity and metallurgy, et cetera, et cetera. So that's all I've got. My time's up. Thank you very much and good luck.